So I think the best way to describe the global economy, it's in a Goldilocks phase. So what do I mean by that? And so it's not sort of too hot, but it's not too cold. So looking at what debt markets currently think, they're starting to price in an interest rate reduction of 0.25% in September. Diversification is absolutely key right now. The UK story has been driven by the domestic sort of economic backdrop, and that is not strong.
Hello and welcome to this month's Market Insight. Today I'm joined with Ian Hooper, Chief Investment Officer at Progeny. Welcome, Ian. So let's have a look at the big picture. August seemed broadly positive in terms of markets. What drove market performance?
So financial markets are benefiting from a tailwind. Economic growth is moderating, but we're still seeing earnings growth of between 5 and 10% in larger companies, in multinationals, and particularly the technology companies. Fiscal policy is also not too restrictive, it's supportive, and companies are coping with the current tariff situation from President Trump. And looking at sort of defensive assets and sort of debt issuance, debt markets are not overly worried about future debt issuance as well. So as a result, markets may progress in August.
So that's really encouraging to hear. It actually feels like we're in a relatively kind of balanced phase at the moment with like conditions looking broadly supportive. How are things shaping up then for the global economy?
So I think the best way to describe the global economy, it's in a Goldilocks phase. So what do I mean by that? And so it's not sort of too hot, but it's not too cold at the moment. If we look at some of the sort of business survey data that's come out recently, it is sort of moderately expansionary. So we are still seeing progress. But if you look, for example, manufacturing data, that is trending towards sort of more stagflationary conditions. So slowing growth, rising inflation. But then you look at sort of business services data, that is making sort of slower expansionary progress across most economies. In sort of GDP terms, sort of gross domestic product terms of the largest economy, the US, first part of the year, the average GDP growth is about 1.2% on the first part of this year. So again, steady but slow progress. We expect for Q3 this number to be around 1 to 2% again. So again, very steady progress as we go into Q3.
So it basically feels like the global economy is walking a bit of a tightrope at the moment. There's just enough growth to keep investors happy, but not enough to kind of spark any real momentum here. In terms of, from what you've said, it's kind of looking like a little bit of a lukewarm kind of growth picture moving forward. So if that's kind of happening kind of broadly, turning to the US then, what's the current economic picture looking like there?
So the big headline news over August was the non-farm payrolls. And basically what those numbers told us is that the labour market is starting to slow. So there was the Jackson Hole event. This is a forum for all central bankers. It's a big forum, gets a lot of headlines and press attention. And the Federal Reserve Chairman sort of stands up and says his view of the world. And what he said at Jackson Hole was actually the economic risks are starting to shift in a different direction. And that the markets read that to be, we're going to see a trigger in the change of interest rate policy.
So taking all of that into consideration then, Ian, where do you think interest rates are going to go from here?
So looking at what debt markets currently think, they're starting to price in an interest rate reduction of 0.25% in September. And that was a sort of big defensive asset piece of news in August.
Okay, so I imagine then that, the White House has its own views on rates, where they should be heading. Are they going to apply any pressure, do you think?
Absolutely. There's been a lot of pressure. There was a lot of press headlines in August about the White House and their views. And they're putting pressure in two areas. One, rates should be lower. That's what they're pushing out at the moment. And secondly, this change of personnel in the Federal Reserve Board, which is quite controversial, and getting some new people to run the Fed, which again has grabbed a lot of headlines through the month.
So the mix of like softening data and the political noise that could make for some quite unpredictable market movements, really, especially kind of looking ahead. So speaking of that kind of uncertainty, if we shift to inflation, so how's inflation affecting interest rates at the moment?
So should we start with the global picture on inflation? So what are we facing? We're facing the threat of tariffs, of increasing food prices, energy prices. We're moving into the autumn in the UK, and we'll maybe come on to that. We're seeing in tight labour markets wage inflation. So I think if you go across the sort of major central banks, every one of them is suffering with inflation expectations trending higher than they would like at the moment.
So do you think we've got an inflation problem in the UK?
I think we have, based on the Monetary Policy Committee's target. If you look at sort of core inflation, headline inflation, it's about 3.8%, and that's well above the target that the Bank of England would like to see of 2%. So on just numerically, yes, we've got some persistent inflation, and what that's doing, of course, is again, back to the debt markets, they're starting to price in that actually that might be it for now for interest rate decreases in the UK because of this persistent inflation.
So kind of given all that data, do you think rate cuts are still on the table then?
Well, the markets are saying no. The minute they think for this year, that's probably the end of any rate decreases. And if you think about it, we're moving into autumn, and we're going to be turning the heating on, we're going to be putting the lighting on more, energy costs are going to rise, aren't they? And so I think that at least in the short term, inflationary pressure will increase, and we might see inflation in the very short term start to top back over 4%. So that in that environment, it seems that's a challenge for the MPC to go, we'll start reducing rates again, but we'll see.
So let's revisit the US tariffs that were introduced in April. Have they actually unfolded as Trump intended?
Shall we put some numbers around that? So if we look at the current sort of tariff revenue, it's running around $300 billion. Huge number. Now, Goldman Sachs have just said about 60% of that tariff burden is being sort of taken by US companies. So there's going to be an impact of tariffs, which we know is around the corner, and that's one of the uncertainties in the outlook for markets around what's the long-term impact of this level of tariff that's not been seen for such a long time.
So in terms of US companies, what's happening now? What's with their results? What's going on?
So if we look over the last sort of quarter of numbers from the major US index, about 3/4 of the businesses actually exceeded expectations in terms of numbers. So backward looking, very positive. So the largest, most prominent business to report numbers recently in the US was Nvidia. A lot of press attention around that stock at the moment, and it produced some broadly positive numbers, but it missed its revenue data center forecasts. So any sign of weakness, the market is going to sort of jump on that because of the valuations are running above historical averages, and that sensitivity to any potential bad news is going to have an impact, and that's where we are, I think, in some of those technology stocks at the moment.
So on the back of those numbers then, Ian, they sound quite positive. Was the US the best performing region?
Actually wasn't in August. It was Japan that was the best performing region. The reason for that is that Japan and the US signed a tariff deal at the end of the month, again with some broader economic data that supported it. So in local currency terms, Japan was the sort of standout regional performance on the month.
So that all sounds really positive, Ian. In terms of kind of risks, is there any risks we should be wary about in these regions?
So absolutely, there is a risk that's been growing now for some time, and that's one of concentration risk. And it's around the Magnificent Seven, the technology companies, particularly these AI companies, in some of the valuations that they're on. Let's put some numbers behind that. So if we get Microsoft and Nvidia and their market capitalizations $4 trillion, that's about the same as all the major blue chip, the biggest blue chip, the biggest companies in the main European index. And there's about 50 of those. Mm-hmm. So there's becoming this imbalance between 2 or 3 very big companies and the rest of the world. And of course, what that means is when those companies do poorly, you're going to see a bigger impact on markets. And that's concentration risk right there. This is something I think that's being viewed very cautiously at the moment by investors, because there's a lot of return coming from just a few stocks on some very big valuations. Now, that's not to say that technology and AI are not here to stay, but I think there's some vulnerability in the short term that any underperformance will adversely affect the markets.
That's really interesting. So Japan's outperformance, that's understandable. But as you've kind of mentioned, the spotlight continues to remain on the US. So I think the real challenge now seems to be, looking forward then, performance of that Magnificent Seven, as you mentioned. Closer to home, looking back at the UK, how is it holding up within the UK? What's our story?
Okay, so the UK story is not as strong as the US. We don't have the technology stocks in our main indices. So the UK story has been driven by the domestic sort of economic backdrop, and that is not as strong. And that's why the UK hasn't performed as well. Thinking about it in a more positive way, the reason that perhaps look at UK companies is the ability to pay dividends, so income distribution from the companies. So the Computer Share Data Monitor put out some data recently saying that UK companies will pay in the region of £85 billion this year in dividends, and that's about a 3% increase on last year. So there are reasons to be positive, but the economic backdrop to the UK, sort of domestically, not as strong as other parts of the world.
So I suppose what you're saying is that even though the UK's economy is facing challenges, it's lagged behind in August, its strong dividends payouts kind of still make it an attractive place to invest for income-focused investors.
Exactly that.
Yeah. Excellent. So turning then to factor performance, what stood out in August?
So on the back of the anticipation of a rate reduction in the US smaller companies did particularly well. It was the sort of smaller company factor that was the highest performing factor on the month.
So we're starting to see variation in interest rates, inflation. What does that mean for defensive assets?
So if we look at the US this month, US Treasuries rallied, of course, in anticipation that we're going to see a rate cut in September. You go to the UK, well, the inflation numbers for July were worse than expected. So, of course, we saw a different impact on sort of UK gilts. As I said earlier, the market's now starting to price in that, in fact, there won't be any more interest rate cuts this year, and of course, we're starting to see that priced in to the UK gilt market over the month.
So not such a good month for UK gilts then, and suggesting that markets are still a little bit uneasy. So given the current market conditions, how should investors be positioned for their portfolios?
So if we look at sort of growth asset valuations right now, they are running above sort of long-term averages, particularly in the US. So a lot of that sort of good news is baked into growth asset prices today. So I think from a positioning perspective, and we've talked about this before, diversification is really, really important now, because there are clearly some risks coming towards us as we go towards the back end of this year. So when I talk about diversification, I mean in terms of asset class, I mean in terms of region, because the prospect of perhaps tariff-related risks or higher inflation, again related to tariffs, appear to be still around the corner. So, and I said this before, diversification is absolutely key right now because markets have done particularly well, but there are definitely some hurdles to get over as we go into sort of the fourth quarter of this year.